morning, everyone. Mike Paciotti, iCM's Chief Investment Officer, back again for this week's Markets in a Minute. In what was a short week last week with the Martin Luther King Day holiday on Monday, it was certainly no less dramatic with everything from geopolitics to economic data moving markets. So let's just get right into it. The week began with heightened investor anxiety after President Trump escalated his push to acquire Greenland, threatening tariffs of between 10 and 25% on multiple European nations, sparking a sharp sell-off in global equities, with many indices posting their largest one-day declines in months. Safe havens became the beneficiary, safe havens like gold, surging amidst the uncertainty. Interestingly, and perhaps not that surprising, U.S. Treasuries, despite their haven status, also sold off on fears that Europe might retaliate by a disorderly exodus from treasuries. Now, folks, I can't emphasize this enough. Such a scenario is highly, highly unlikely. A disorderly liquidation designed to punish the U.S. would also strengthen their local currency and make their exports more expensive. So essentially cutting off their noses to spite their own face. Now, a day later, markets rebounded after President Trump announced a framework for future cooperation on Greenland, essentially withdrawing the imminent tariffs and ruling out military action. So taco trade, maybe art of the deal, also possible. Now turning to Japan, long-term Japanese government bonds contributed to Tuesday's volatility. Yields spiked as much as 27 basis points on fiscal concerns, with the 30-year bond reaching 3.88% and the 40-year bond topping 4%. Now, for perspective, that would translate to roughly a 5% one-day loss if that were the U.S. long bond. So major, major volatility. Now, why does this matter? Japan is considered a safe haven, much like the U.S. As Japanese yields become more competitive, they could put upward pressure on U.S. Treasury yields as investors evaluate alternatives, right? There's also implications for banks and the carry trade, reminiscent of dynamics seen during the banking crisis just a few years ago. Certainly something that's worth watching. Now, on the economic data front, final revision to Q3 GDP came in slightly higher at 4.4%. PCE, the Fed's preferred inflation gauge, was on the button at 2.8% for both headline and core. One note, though, first look at Q4 GDP, originally scheduled for this week, has been pushed back to February 20th due to data availability. So more to come on that in just a few weeks. That's going to be it for this week. Looking ahead, tech earnings are in focus this week with Intel, Microsoft, and Meta all reporting. So have a great week, everyone, and we'll see you next Monday.